Hello, everybody. Welcome to Wednesday. The S&P 500 was down 2.5% today, really kicked off by some comments from Federal Reserve Chairman Powell. The reason that we have our models and most of the assets that we're managing in T-bills, ultra short-term bonds, and inverse positions that actually go up when the market goes down is because of what is being said and done by the Federal Reserve. And really, it drove down the market substantially today, and our models were up. We still have assets in legacy positions and high capital gain positions that we've retained, which obviously had some issues today. But we've had these inverse positions all the way through this run up in October, and the reason that we kept them is because of the fact that you look at the 2-year Treasury yield, it's continued to gain all the way through this run up. And what that means to me is that the Federal Reserve is likely to continue to run up rates. And the big comment that came from Chairman Powell today was that they felt like the terminal rate, so the ultimate rate that they might get to, would be higher than what they expected just, in the last meeting in September. And so the market responded right away. You could see it to that comment. And if you look at the futures market for the Fed funds rate, it's now up to 5.1% at the top. And so they were projecting 4.6, 4.75% back in September. So that's continued to grow. So what's going to happen here, most likely, if inflation continues to stick around, which it has been, the projections for inflation that's going to be reported next week are still fairly close to where they were last month. So we haven't had really any drop. And we'll see the actual numbers next week. But if that's true, we're having this kind of sticky inflation scenario, even though they are raising rates. We have earnings that are now lower than they were. The stock market's got to adjust to that, to the downside. This is a very difficult environment for the stock market to just go skyrocketing up and turn into another bull market. And so we have to watch that 2-year Treasury yield. Once it starts to fall over, starts to project that the Federal Reserve, might at least stop raising rates, if not actually start to pivot to the downside, that might be a great time for the stock market. We just haven't seen that yet. So I think there's a couple of situations, and the Federal Reserve Chairman talked about this a little bit today. Number one, they get to the terminal rate, and then they're going to stay there as long as possible to try to, bring down inflation to their 2% target. The other scenario that they didn't talk about, which is often a situation in these scenarios, is where something breaks, some emerging markets falls apart, or company like Lehman Brothers, goes out of business and creates this kind of toppling effect. And that would be a situation where the market might drop 10 to 30%, for the stock market, and would maybe make the Fed pivot quicker. They'd have to start maybe lowering rates to support that market. Hopefully in that environment, there's a situation where inflation could drop also, so that could work out quite well. And so we just don't want to ride through that. We're trying to protect the clients from that type of downturn because the recovery time is really long. I mean, it took 5 years to recover from 2008, and 14 years to recover from the Depression, et cetera. So, being a little cautious right here where the market is and all the different things that are happening with Ukraine and China and all these things makes some sense to me. And that's why we're sticking with this, at this point in time. But very fascinating day, really interesting to see what happens tomorrow. What's the carry through tomorrow after 2.5-point drop today? What happens on Friday when they give the jobs report? What happens on Tuesday when we get the midterm election happening? What happens next week? I think it's Thursday for the CPI inflation number that is going to come out. Again, it's expected to be roughly the same, but we'll see what happens there. How does the market react to these? So there's a lot of different things still to go here. Really interesting time to be watching the market. You can learn a lot for what's happening here. But again, I think overall we're in a downward market. The best place to be in an overall downward market is to make money off of that with inverse positions, and wait until we see some signs that we can start to turn around into an overall upward market. I think that has a lot to do with watching that 2-year Treasury yield rate and see when it starts to peak out. But anyway, look forward to being able to talk to you again tomorrow. Thank you.